Imagine this. You've finally saved up $5,000. You're doing absolutely everything right. You're earning, you're saving, you're investing, and then boom, your car breaks down. Out of nowhere, one single unexpected emergency wipes out almost everything you've worked so hard for. Welcome to today's Explainer, where we're tackling something that honestly doesn't get nearly enough hype. We hear all about how to make money, right? But today, we're focusing on how to stop one unexpected shock from completely destroying the wealth you're building. So let's just dive right in. So here's a pretty heavy question for you. Would your financial plan actually survive a total surprise? I mean, when you check your banking app, you probably see your income and your expenses, right? But right beneath the surface is this massive vulnerability of unprotected assets. Because personal finance, it's not just this perfectly straight line of earn, save, and invest. That equation is actually totally incomplete. To truly secure your future, there's a final, absolutely crucial step. You have to protect it. Yeah, and to really see why this matters, let's talk about someone we can all probably relate to. Let's call him Alex. So Alex is 22, making $2,500 a month. After about $1,900 in everyday expenses, Alex is tucking away a fantastic $600 every single month. Month by month, those savings are steadily climbing. $1,000, $2,000, $3,000, up to $4,000. Alex is checking that bank balance thinking, man, I am crushing it right now. And, it totally creates this beautiful illusion of total financial safety. But then life happens. A major car accident out of absolutely nowhere. Suddenly, Alex gets hit with a massive, unexpected expense. And here is the really harsh reality we have to talk about. Yes, Alex has savings, but Alex doesn't actually have enough protection. Saving your money just doesn't equal complete risk management. Just like that, the cash Alex worked so incredibly hard to save is entirely wiped out. So what exactly went wrong here? Well, what Alex just ran headfirst into is called personal risk. Basically, personal risk is the possibility that some totally unexpected event is going to cause a financial loss or just negatively impact your overall financial well-being. And honestly, this can come from anywhere: a sudden health issue, losing a job, property damage, a crazy natural disaster, or even fraud. The really important takeaway here, you can't always stop these things from happening, but you absolutely can prepare for the financial fallout. Now, there's a really critical distinction we need to make here. People use the words risk and loss interchangeably all the time, but in the finance world, totally different things. Risk simply means there's a chance, a possibility of something going wrong, like the possibility that your car might get dinged up. Now, a loss is what actually happens when that risk becomes reality. It's the literal financial consequence. So the risk is getting into the accident. The loss, that's the actual $3,000 repair bills sitting on the counter that you now legally have to pay.
And here's a pro tip to keep in your back pocket. Not all risks are created equal, so you definitely shouldn't treat them like they are. When you're sizing up a risk, always ask yourself two questions. 1, how likely is it to happen? And 2, how expensive would it be if it did? For example, a high-frequency but low-cost event, like say spilling your $20 artisanal coffee, is a bummer, sure, but it's an expense you can easily absorb yourself. But a low-frequency, extremely high-cost event, like a $50,000 medical emergency, that kind of thing could be completely devastating to your finances.
Okay, so the big question is, how do we actually handle all these different types of risks? How do we build what I like to call a financial shield? Well, there are a few ways to manage financial risk, but we can really boil them down to 3 super powerful strategies that put you right back in the driver's seat. Strategy number 1 is avoid. Number 2 is retain. And number 3 is transfer. Let's walk through how these actually stack up to build your defense. Let's kick things off with strategy 1, which is honestly a major money move. Avoid. This simply means reducing unnecessary financial risk before it even has a chance to happen. The absolute easiest way to handle a risk is to just eliminate the behavior causing it. If you know that texting while driving dramatically bumps up your chances of crashing, you just don't text and drive. Simple, right? In your financial life, this looks like not handing out your banking passwords, steering clear of really high-interest debt, using secure payment apps, and keeping your sensitive documents locked down. You're literally stopping the risk at the front door. But let's be real. We know we can't avoid every single thing in life, right? So that brings us to strategy number 2, retain. I know, retaining risk sounds kind of intimidating, but it's actually super empowering. Retaining risk just means you're accepting that, hey, I might have to pay for a small loss myself. Instead of buying some ridiculous specialized insurance policy for every little $20 accident, you just handle it. And how exactly do you handle it? with an emergency fund. This is cash you've set aside specifically for surprise expenses. Think of your emergency fund like a financial shock absorber. When you hit a pothole, instead of swiping a high-interest credit card, your emergency fund absorbs all the impact.
Exactly. But what happens when you hit a bump that is just way too big for that shock absorber? That's where we get to strategy 3, the final layer of your shield, transfer. Sometimes a potential financial loss is just way, way too large to comfortably handle on your own, like that $50,000 medical bill we mentioned earlier. When a risk is that massive, it makes total sense to transfer it to an insurance company. Insurance is really just a contract designed to give you financial protection against specified risks, and in exchange, you pay a premium. You're basically shifting that massive financial weight completely off your own shoulders.
And just like any good toolkit, you've got specific tools for specific jobs. Different types of insurance protect against completely different risks. The 4 major ones you absolutely need to know about are health insurance, which helps manage all those crazy healthcare costs, auto insurance, which protects you from vehicle-related losses and liabilities, home or renter's insurance to cover your property, and life insurance, which can provide a massive financial safety net for your family if you were to pass away. But hear me loud and clear on this one. Do not, under any circumstances, just buy an insurance policy because someone told you to. You really have to intimately understand exactly what risk you're actually transferring over to that company. Right, and to really understand how to do that, let's run through a quick, rapid-fire vocabulary check. These are terms you absolutely have to know, starting with premium. The premium is simply the amount you pay for the insurance coverage itself. Think of it kind of like a subscription fee for Netflix or Spotify. It's the regular cost you pay, maybe every month, maybe once a year, just to keep the policy active and maintain that protection. Next up on the list is the deductible. Now, this is the one where a lot of people tend to get a little confused. The deductible is basically your out-of-pocket threshold. It's the amount of money you have to pay yourself first before the insurance company even steps in and starts covering the rest of the loss. And finally, we have coverage. This is essentially the beating heart of the contract. Coverage spells out exactly what risks, what specific losses, or what services the policy is actually going to protect you against.
And if I can just jump in right here real quick, this right here is exactly why you have to read the fine print. Cheaper coverage is definitely not always better coverage, because if you're paying a super low premium, but your coverage actually excludes the exact risks you're most likely to face, guess what? You aren't actually protected at all.
Which leads us directly into what I call the big mistake. I see this happening all the time, and it is just so incredibly dangerous. People get hyper-focused entirely on building wealth. Like, they'll have $100,000 invested in the stock market, but they have 0 emergency savings and they have absolutely no appropriate insurance. So what happens? One major unexpected event hits, and because they don't have that financial shock absorber, they're literally forced to sell their investments just to pay the bill. And wouldn't you know it, they usually have to sell at the absolute worst possible time in the market. Look, building wealth without managing your risk doesn't make you rich, it just makes you completely vulnerable. Exactly. So let's fix that vulnerability right now. Let's take everything we've talked about and synthesize it into a really practical, everyday system. We call this the 3-step financial shield. Step 1, prevent. Avoid the risks you actually can by just making smart, proactive choices. Step 2, prepare. Build up that emergency savings account so you can retain and handle those smaller bumps in the road yourself. And step 3, transfer. Use the right insurance policies to handle the massive, catastrophic risks. When you stack these 3 layers together, your financial shield suddenly hits 100% protection. Okay, let's actually put your brand new shield to the test with a quick scenario. Take Jordan, for example. Jordan has $2,000 sitting in a savings account, drives a car worth about $12,000, and obviously faces the daily risk of a major accident during the commute. Now, if Jordan just crosses their fingers and hopes nothing bad ever happens, well, that's not exactly a strategy. A smart, next-level thinker would identify the risk, estimate that $12,000 impact, and choose a solid strategy. Jordan needs to prevent accidents by, actually driving safely, prepare by maintaining that $2,000 emergency fund for deductibles or small repairs, and finally, transfer the major risk by having a comprehensive auto insurance policy. Spot on. All right, let's do a rapid-fire recap to really lock all these concepts in. Number 1, personal risk is just the possibility of financial harm from an unexpected event. 2, avoid risks by changing your own risky behaviors. 3, retain risk by being fully prepared to absorb those manageable losses all by yourself. 4, transfer the really huge risks by using insurance to shift that financial burden away from you. And finally, number 5,
Your emergency fund is that vital tool that literally gives you financial flexibility when life inevitably happens. Remember, the goal here isn't to eliminate every single risk in the world. That's totally impossible. The goal is just to make sure one bad event doesn't ruin your entire future.
So, as we wrap up today's explainer, I want to leave you with a bit of a challenge. Take a really close look at your own financial life right now, or even just picture your future financial setup, and ask yourself, what is my biggest financial risk today? Take a second to truly identify it. And more importantly, what strategy, avoid, retain, or transfer can you put into action right now to protect yourself? Earning money is great, but it's only half the battle. You have to learn how to protect it. Thanks for hanging out and learning with us today, and hey, stay protected out there.